So your sales team just crushed it. Record quarter, pipeline is full, leadership is fired up, everyone is high fiving in Slack. Then the finance report drops, and revenue is basically flat. Same quarter, same company, two completely different stories. How's that happen? It happens because the number the sales team is celebrating and the number the finance team is reporting are not the same thing. They were never the same thing, and most people do not realize that until it creates a problem. Today, I want to break down three numbers that if you run a business, if you work in finance, if you sit in any meeting where someone throws around the word revenue, you need to understand. Bookings, billings, and revenue. People use them like they are interchangeable, but they're not even close. Here's where the confusion starts. In most companies, especially SaaS, these three words just fly around in meetings like they all mean the same thing. Someone says revenue is up, but what they really mean is bookings are up. Someone says we billed 2 million this quarter, and the CEO hears that as 2 million in revenue, which is a totally different number. And nobody is lying or being sloppy. The problem is that in everyday conversation, these words feel like synonyms. Think about it from the outside. A customer signs a deal, money shows up, it hits the financials. In your head, that feels like one thing that happened. But it's actually three separate things that happen at three different times, and they can be weeks or even months apart from each other. And this is not just some accounting technicality that only your controller loses sleep over. When you mix these up, you end up making real decisions on the wrong information. You hire too fast, you project cash that's not coming when you think it is, you walk into a board meeting telling a story that does not match what the bank account says. That's where it can get expensive. All right, let's start with bookings because this is the one that gets everyone excited. A booking happens the moment a customer commits, when they sign the contract and agree to the deal. Think of it as a promise. The customer is saying, I'm going to pay you this much for this thing over this period of time. It is completely forward looking, meaning it tells you what is coming, not what is here yet. So if a SaaS company signs a customer to a 12-month contract worth $120,000, that entire 120K counts as a booking on day one. The full contract value gets recorded the second that deal closes. Now here's the part that surprises a lot of people. Bookings is not a financial metric at all. You will not find it on an income statement, balance sheet, or cash flow statement because it does not exist in the accounting system. It is a sales metric that lives in your CRM, in your pipeline reports, on your sales dashboard, not in your general ledger. And the big part of what makes it so confusing, because people hear a big dollar number and naturally assume it is a financial figure when it is actually a measure of demand and commercial activity that is completely separate from the financial statements. So that 120K deal is real. The sales rep is getting their commission on it, but no cash has hit the bank yet and no revenue has been recognized. The only thing that has actually happened at this point is a commitment on paper. And that is exactly why the sales team and the finance team can both be telling the truth while reporting totally different numbers. Your VP of sales stands up at the all hands and says, we booked 3 million this quarter, and that's accurate because that is what the team closed. Then your CFO gets up and says revenue was 1.8 million, and that is also accurate. Same company, same quarter, two very different numbers, and both of them are right. They are just measuring completely different things. So if bookings is just the promise, what actually happens next? Billings is the invoice. It is the moment you actually send the customer a bill and say this amount is now due. Going back to our $120,000 deal, that contract was signed and that is the booking. But how you bill for it depends entirely on your terms. Maybe you bill the whole 120K upfront as one big invoice on day one. Maybe you bill quarterly at 30K every 3 months. Maybe it's monthly at 10K per month. The bookings is identical in every scenario, but the billings look completely different depending on how the contract is structured. And this is where cash flow enters the conversation, because billings is the closest of these three to actual money moving. Once you send an invoice, you are waiting for the customer to pay it. It is not cash yet since it is sitting in accounts receivable, but the invoice is the trigger. No invoice means no payment, which means no cash. So when someone says billings were strong this quarter, what they are really telling you is that a lot of invoices went out and cash should be on its way. Let me give you a scenario that happens constantly in SaaS. Huge Q4, sales teams went on a tear. closes a bunch of big annual deals, and everyone is celebrating. Bookings are through the roof, but most of those deals have net 30 or net 45 billing terms, and half of them were signed in the last 2 weeks of December. So the invoices do not even go out until January, which means the billings for Q4 do not actually reflect Q4 bookings at all. And cash from those deals not showing up until February or March. That is 3 months between the celebration and money actually landing in the bank. Okay, so we have the promise and we have the invoice. Where does revenue fit in all this? Revenue is the one that accounting controls, and honestly, this is kind of the grown up of the group. Revenue gets recognized when the service is actually delivered, not when the deal was signed, not when the invoice went out, but when you do the thing the customer is paying you for. This is the concept that trips up most people. Back to our 120K annual contract. The deal was booked on day one, and let us say it was billed up front, so the customer paid the whole 120,000 in January. Cash is in the bank, which feels great, but revenue only gets recognized at 10,000 per month, spread evenly across the 12 months of the contract, because that is the period you are actually delivering the service. So think about what that looks like. In January, you have 120K in cash sitting in the bank, but only 10,000 in revenue on the books. In February, still 120K in total cash collected, but now 20,000 in cumulative revenue. The other 100,000 is sitting on your balance sheet as deferred revenue, which is money you have collected but not earned yet in the accounting sense. You still owe the customer 10 more months of service before you can call all of it revenue. And this is not just some made up rule. There is an actual accounting standard called ASC 606, and the core idea is pretty straightforward. You earn the revenue when you deliver what you promised. For a SaaS company, that means giving the customer access to the software each month. For a consulting firm, it might be delivering milestones or billing hours. The pattern changes, but the principle remains the same. So yeah, you can absolutely have a company that collected $5 million in cash, booked $8 million in new deals, and shows $3 million in revenue on the income statement. All three of those numbers are correct. They're just answering completely different questions about the business. So let's put the whole thing together with one complete example, because this is where it starts to click. Say you run a SaaS company, and in October, your sales team closes a $240,000 annual contract with a mid-market customer. This is a big deal for your company. Here's how that single deal flows through all three metrics. Bookings. We got $240,000 recognized in October. The full contract value hits your bookings number the moment the deal closes. The sales dashboard lights up, and the reps get their commission calculated on that full amount. In Billings, we bill quarterly in advance. So in October, you send a $60,000 invoice covering October through December, then another $60K in January, and then another in April, and finally another in July. Same deal, but the billings happen 4 separate times across a full year. Finally, revenue. $20,000 a month every single month, October through September of the following year. Straight line recognition because the service delivery is consistent, steady, and predictable, but it just takes 12 full months to recognize what the sales team booked in one afternoon. One deal, one customer, and look at how different the picture is depending on which number you pull up. October looks like a 240K month on bookings, a 60K month on billings, and a 20K month on revenue. Same deal, wildly different numbers. And this is why I care about this so much. Getting these mixed up does not just make for an awkward moment in a meeting, it can lead to real operational mistakes that cost real money. First one is hiring based on bookings. Your sales team books $2 million in new annual contracts in Q1, and leadership sees that and thinks we have $2 million in new revenue, so it's time to scale. So they go hire 10 engineers, 3 customer success managers, but that $2 million is spread over 12 months, and the actual revenue from those deals in Q1 is maybe $300,000 to $400,000. You just committed $1.5 million in annualized payroll based on revenue that takes a full year to materialize. That is exactly how a growing SaaS company runs itself out of cash quickly. The second one is forecasting your cash based on revenue. Your revenue is growing 20% quarter over quarter, and it looks amazing on a chart, but the revenue recognition is backward looking. It tells you what you delivered, not when the money arrived. So if your billing terms are net 60 and your customers are slow payers, You could be recognizing revenue in March while the cash does not hit your account until June. The revenue chart says growth, the bank account says where is all the money going. Third one is confusing the board, and this is a credibility killer. A founder walks into a board meeting and presents a $5 million quarter. Board members ask about cash collections. Only $2 million. Now there's an uncomfortable silence in the room. Nobody did anything wrong. It's definitely not fraud, but it is a fundamental mix-up that erodes trust really fast. Every one of these mistakes starts the same way. Someone looks at the biggest, most exciting number and assumes it tells the whole story. But each of these three numbers answers a different question, and you need all three to actually understand what is going on in the business. So here's how I think about it, and this is dead simple. 3 numbers, 3 questions. Bookings tells you how much demand do we create. Billings tells you how much do we invoice and when is cash coming. Revenue tells you how much do we actually deliver and earn. Demand, cash timing, and earned performance. That's the whole framework. Each one matters to a different person at a different time. Your sales leader cares about bookings because that is the health of the pipeline and the go-to-market engine. Your finance team cares about billings because that drives cash collections and working capital planning. Your accountant and your board care about revenue because that is the number on the income statement, the one that gets audited, the one that determines whether you are actually growing the way accounting standards say you are. When all three are moving together and growing at roughly the same rate, things feel clean and the business feels healthy. But when they start diverging, that is when the most important conversations need to happen. If bookings are surging but revenue is flat, you've signed a bunch of long-term deals that have not kicked in yet, which might be fine, but you need to plan for the lag. If billings are flat but bookings are up, maybe your terms shifted or you moved from annual upfront to monthly billing, which is a cash flow decision with serious implications. The point is not that one number is better than the other. They each tell you something different, and you need to know which one you were looking at and why. So next time someone in your company says revenue was up this quarter, ask a follow-up question. Did you mean bookings? Do you mean billings? Or do you actually mean recognized revenue? Because the answer can change things. If this was helpful, please hit subscribe. I'm building a whole library of this kind of content, not textbook finance, but the stuff that actually shows up in real meetings with real decisions and real consequences. Next time, I want to go deeper on the bookings side of what we covered today, specifically the pipeline that feeds your bookings number and how to know whether it's actually healthy. There's a metric called pipeline coverage ratio that tells you whether your sales team has enough in the funnel to hit their target, and most companies either do not track it at all or are tracking it wrong. If you've ever been surprised by a missed quarter even though the pipeline looked full, that is exactly what we're getting into next. See you then.